The problem with interest. First of all, what is interest? Usually, people say it is the price for borrowing money, particularly from the banking or financial market. Generally, we say it is the price for liquidity. Liquidity is what enables one to easily buy and sell in the economy. Good liquidity enhances economic growth and standards of living, while poor liquidity inhibits economic progress. To illustrate this, take for example the time of bimetallism, where gold and silver coinage were circulated as money. Silver was the main money in the market for small purchases, while gold for large transactions. Transactions are well facilitated with enough money in the economy, i.e., having good liquidity. However, when silver was demonetized, for example in 1873, there is now less money in the economy and liquidity is hampered. Only the rich in the economy have gold coins and can now be used as money. Only the rich in the economy have gold coins that can now be used as money. Others without gold, now forced to borrow gold from those who possess them so that they can also transact in the economy. For this, they are charged interest. Hence, interest thrives when liquidity is scarce. For example, here this person here is having a lot of gold, and here this without any gold. And the economy goes into a recession simply because there's lack of liquidity. So therefore, interest is basically the price for liquidity. Effects of interest rate. First of all, interest is partly responsible for continuous inflation in the economy that causes ever-rising cost of living. So we can see here that interest causes money to grow exponentially in the economy, exceeding that of the real economy. This is the real economy. Why? The reason is the interest rate in the formula, it has the power of n, which is an exponential function. So hence, if you take the data for money and debt for almost any economy, this is how you'll observe the growth of money and debt. Secondly, debt is not repayable in aggregate, which means some of the borrowers are sure to default simply by the structure of the system. To illustrate this, we can see here, let's say this is the economy and 1,000 is borrowed. Let's say the banking sector creates the 1,000 and lends it to someone at a rate of 20%, the annual percentage rate. So 1,000 is borrowed at time 0 and need to pay back 1,200. But the 200 that is to be paid as interest does not exist in the form of money. Only the 1,000 exists in the economy. So if the person were to pay back 1,200 at the end of the year, the default would become obvious. Now notice if the person has to pay back the loan 100 per month. So 100, 100 for 12 months equals to 1,200. When the 100 is paid to the bank spends back the money into the economy. So therefore, goods and services get transferred to the bank. So therefore, as each 100 is pushed back into the economy, the default becomes camouflaged. In other words, the default is not obvious, but goods and services would have transferred to the banking sector. Thirdly, this lack of money for interest payment makes money always scarce in the economy. This encourages competition in the economy between individuals and businesses rather than cooperation and compassion. Fourthly, it requires endless economic growth. This can be seen from the equation of exchange. MV equals to PY. M is the quantity of money in the economy, like M2. V is the velocity of money circulation. P is the general price level. And Y is the real economic output of goods and services, generally measured by GDP at constant price. So if money grows constantly and V is taken to be a constant, and Y must also grow at the same rate of M if you do not want the price levels to go up. So as the money grows because of interest, the Y must also grow so that the cost of living or price levels remain constant. Next, it concentrates wealth in the hands of a minority by taxing the majority. This is because new money is mostly created by privately owned commercial banks, which is also given to the rich people in the economy who appear to be more credit worthy, causing money to circulate among the rich in the economy. This M here is generally created by the banking sector and given to mostly the rich in the economy. The middle income and low income group who borrow money from them simply transfer their wealth to the high income group through interest charges. So, it concentrates wealth in the hands of a minority by taxing the majority. Implications for financial management. All these have implications for financial management of firms, individuals, and the government. The debt levels of all would keep rising, while the net creditors would be the bankers who have been given the legal right to create money out of nothing and lend to others at compound interest. Next is the total debt is not repayable in aggregate. Debt default is by design of the system, and interest can only be repaid in real terms. So imagine nations borrowing money from international lenders like IMF and World Bank. The interest portion can only be repaid in real things, and some nations are bound to default because there is simply not enough money in the first place. Next, mixed match in the risk profiles of the real economy and fiat money. Real economy is risky, but fiat money demands a riskless cash flow. Hence, the whole global fiat money system is simply unsustainable and is waiting to collapse. New monetary systems based on risk-sharing principles are therefore warranted. Thank you. Bye.